Texas Roadhouse stock, ticker symbol TXRH. This stock is up 16% on the 1-year chart, slightly underperforming the S&P 500. On the 26th of October, TXRH presented quarterly earnings with a miss on both the EPS and revenue. For the upcoming earnings mid-February, almost all analysts expect a miss on earnings again, potentially pushing this stock down. More on that later in this video. But first, people love TXRH stock because of multiple reasons, and one of the main things being the dividend. And I understand why, with dividend yield at 1.88%, which is pretty good. But look at that 5-year growth rate streak of 17%. And if we look at the past 5 years, we see that TXRH slightly underperforms the S&P 500, and this is including dividends. So could this be the perfect time to buy TXRH stock? Well, by the end of the video I will give you my 3 price targets, so make sure to stay tuned and see how I build up to these price targets. And more importantly, which price target is the most justified in my opinion. I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does TXRH do? Texas Roadhouse is a restaurant company operating in the casual dining segment. The company's operating segment includes Texas Roadhouse, Bubba's 33 and others. It generates maximum revenue from the Texas Roadhouse segment. And if we dive in the most recent earnings report, we see that total revenue was reported at $1.12 billion, up almost 13% year over year. To me, this looks really good. However, income from operations decreased almost 2%, so that's something to keep your eye on. Net income increased 2.3%, and because of that, earnings per share increased 2.6%. A thing that is really standing out here is that the 39-week ended period is showing higher growth numbers versus the most recent 13-week period. And Texas Roadhouse can easily increase revenue by opening new restaurants. But you want the existing restaurants also to grow. So it is very important that comparable sales is going up. In here we see that it increased 8.2%, which is a great number in my opinion. Restaurant margin dollars increased 7.1%, primarily due to higher sales. Restaurant margin as a percentage of a restaurant and other sales decreased 80 basis points to 14.6%. As commodity inflation of 4.2%, wage and other labor inflation of 5.6%. And 9 company restaurants and 4 franchise restaurants were opened, including the first Jaggers franchise restaurant, so this is also really exciting. And last but not least, TXRH bought back 107,593 shares, which is really nice. This will increase your ownership in the company. Mid-February, Texas Roadhouse will present the 2023 full-year results, and it is expected that comparable sales increase 9.2% compared to 2022. Next to that, it is expected to see 27 new restaurants for Texas Roadhouse and Bubba's 33. For 2024, things also look really interesting, with a positive comparable restaurant sales growth and a 8% increase in the store week growth. Commodity and cost inflation to about 5 to 6% increase, and wage and other labor inflation an increase of 4 to 5%. To me, this looks pretty decent at all. And now that we know a bit more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Texas Roadhouse stock is a 7.8 billion market cap company. PE ratio is at 26, indicating they are at a premium price right now. Later in this video I will show you my 3 price targets for TXRH, so make sure to watch until the end. And in the meantime, please let me know your thoughts on the current valuation on Texas Roadhouse. And I'm also interested to hear your thoughts in general on this company. Revenue is at 4.48 billion, and in this graph we see that revenue went up in the long run. And this is one of the reasons why I like this company so much. It's growing so consistently for a restaurant company, and of course we see the impact during the lockdown periods. Margins are going up in the long run, which is really nice. And again, you see the effect of the lockdown periods. It is really impressive how quickly they recovered from that period. EPS is pretty much the same story as the revenue and the margins. It is growing really steady and consistent. Analysts expect that EPS is growing really nice and steady in the coming years, all the way up to $7.2 per share. On a yearly average, you're looking at 13 to 17% increase. To me, this looks really good. For the revenue, analysts expect pretty much the same pattern. The only difference is that the growth numbers are a little bit lower with 8 to 10% growth per year on average. Return on assets is sitting at almost 8%, which is a great number. Return on equity looks really good, and the most important number, return on invested capital, is sitting at 11.5%, which is a great number for this type of company. It is also higher versus the 5-year average, which is very nice. Current ratio is at 0.32, which is a decent number for a restaurant company. It is also pretty steady historically, so this looks good to me. Right now, Texas Roadhouse has $757 million in debt, and I prefer companies that can pay down at least a big chunk of their total debt with the total cash. Texas Roadhouse has $69 million in total cash, so they can't pay down a big chunk of their debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run at a pretty steady and consistent pace, so this comforts me a lot. And again, we see the impact during the lockdown periods. Shares outstanding are decreasing in the long run, which is something that I really like. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at 1.88%, which is a decent number. Annual payout is at $2.20 and payout ratio is at 48%. I prefer 50% or lower. So right now they have 52% left in cash to buy back shares, pay down debt, do acquisitions and all other things. And now it gets really interesting. The 5-year growth rate is at 17%, which is an insane number. They have increased the dividends for 1 year in a row. But if you take a look at these numbers, the dividends paid since 2012, you see that Texas Roadhouse did increase the dividends at a high pace. However, during the lockdown periods they cut the dividend, which was a smart move to survive. After things cooled down, they immediately picked up the growth pace again. Payout ratio is a very important metric with dividends. It tells you if the dividends are safe. In here we see that historically it looked really good, around 50%. And again you see the impact of the lockdown periods, with payout ratio exceeding the 100%, which they took care of immediately. And in this graph we see the expected dividends for 2024 and 2025. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase at the same rate as the past couple of years. And overall these dividends look really good to me, but how about the historical returns? I decided to compare Texas Roadhouse stock with the overall market, in this case the S&P 500. Next to that I added Wingstop and Wendy's. On the 5-year chart we see that TXRH had a 92% return, but both the S&P 500 and Wingstop had a higher return. Especially Wingstop is an interesting one with more than 300% return. Wendy's is at the bottom of this list with 35% return. On the 1-year chart things look pretty interesting. Wingstop did beat all stocks in this list by a significant amount again. And TXRH was again really close to the returns of the S&P 500. On the 6-month chart it is again Wingstop with the highest return, sitting at 34%. TXRH again underperforms S&P 500. On the 1-month chart, you guessed it, Wingstop had again the highest return and TXRH again underperforms the S&P 500. Bottom line, TXRH was beaten by the S&P 500 and Wingstop, but it had much better returns versus Wendy's, which is the positive thing here. So could this be the perfect time to buy TXRH stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 8, 10 and 12%, based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm putting in 6.5, 7 and 7.5. For the free cash flow margin I'm putting in 5, 5.5 and 6%. For the PE ratio I'm putting in 20, 21 and 22. For the price to free cash flow I'm putting in the same numbers. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now TXRH stock is at $116. I hit analyze and we only see a few green numbers. We have a low price target of $69 to $89. We have a mid price target of $91 to $116 and we have a high price target of $190 to $149. To me, the mid to high price target is the most justified here, telling me that this stock could be potentially undervalued. Of course, we are sitting in the middle of this range. Let's call it $100 to $150, but I think there's enough upward potential from here. So what do you think is the most justified price target here? My final conclusion on Texas Roadhouse stock is that I love the business. It's a great company that is capable of growing at a high pace in a steady and consistent way. And not only that, they are also capable of growing the existing restaurants, which is really good. On top of that, during difficult times, Texas Roadhouse isn't afraid of making tough decisions. To me, this shows that management is doing a really good job here. And most fundamentals look really good, and again, the steady and consistent performance is really showing me that this is a great company. The only bummer is that the fact that debt is pretty high compared to the cash position. From a dividend point of view, things also look really good. They keep payout ratio under 50%, which is really nice, and they are capable of growing the dividends at a high pace. They also have a long track record of paying dividends, besides the lockdown periods of course. From a value point of view, things look less excited. In my opinion, they are undervalued, but not by a lot. So with the earnings coming mid-February, I hope the stock will go down in stock price due to an overreaction on the expectations. For now I'm waiting for these earnings and in the meantime collecting the dividends and analyze them from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I'll see you in my next video.